Good morning, everyone, and thanks very much for joining me. This is the DAX Open with myself, Russell Shaw, Senior Market Specialist at FXCM, and my email address rshaw@fxcm.com. Today is Wednesday, the 19th January 2022. I'm just going to bring up our high-risk investment warning. Just while I have this on screen, I'm busy working on a document. It should be ready today. It has to be finished today. And we'll launch some sort of, I guess, marketing campaign, Outlook 2022. I'm not sure exactly when it will be sent out. It's still going to go through compliance, but it's also sort of in tandem with a webinar that we're going to hold on the, let me just see, Thursday, the 3rd of February, called 2022 Macro Analysis. It's going to be me and Nikos. We're going to co-host it. I'm just going to put the chat, I'm just going to put the link in the chat. There's a drop down. Just take note. One is for the UK time zone, one would be for the Australian time zone. So that's in the chat now, and of course everyone is cordially invited. Let me just bring up the market commentaries disclaimer. I'll show you some of the charts that I'm working on for this publication. I don't think it'll be too long, maybe sort of 10-12 pages, but so references MarketScope 2.0, tradingview.com, and I'll bring up this chart. This is one of the charts I'll include in the report. I think we've seen it. Let me just move this here. But before we talk about that, let's just go through the Cnbc morning note, which has a headline that reads, European markets head for negative open after Wall Street sell-off. European stocks are expected to open lower as global markets take a downturn after a sell-off on Wall Street on Tuesday, prompted by rising bond yields and worse than expected earnings. That's a bad combination. The lower open in Europe comes after sell-off on Wall Street triggered by surging bond yields, which sent global markets lower in the previous trading session. US bond yields continued their year-to-date climb on Tuesday, with the 10-year Treasury topping 1.87%. We've spoken about that. I'm going to bring that up here as well. It started the year around 1.5%. All right. Meanwhile, the two-year rates, which reflect short-term interest rate expectations, topped 1% for the first time in 2 years. That's, I think, also important. We'll take a look at that in a moment. Investors remain jittery over the U.S. Federal Reserve's schedule for hiking interest rates and tightening its ultra-loose pandemic-era monetary policy. Again, I think we've spoken about that. You know, it's effectively the unwinding of a monetary policy experiment, which in of itself is experimental. So certainly interesting times there. Major US averages also fell sharply Tuesday after Goldman Sachs missed analyst expectations for its fourth quarter earnings. Big bank earnings continue on Wednesday with reports from Bank of America and Morgan Stanley. So we'll get all the banks out. Just by the way, JP Morgan also, it had good earnings, but there was this, a little bit of a sort of a, I'm not sure if you call it a trick, but going into the COVID pandemic, all the banks took money and they just separated it as reserves for bad debts, because that's their buffer, right? It's called self-insurance. And then from last year, those loan reserves started being released in sort of piecemeal tranches. So the loan reserve that JP Morgan released over the fourth quarter, well, that's pushed up earnings. It's been captured in the income statement. It's filtered down to the bottom line. It's reflected in earnings per share. So, but if you take out those loan reserves, they would have missed expectations as well. And then Citibank had a horrendous result. Net income was down over 20%, and they blamed surging expenses in the first quarter. The only one that seems pretty good is Wells Fargo, but Wells Fargo has also come off a low base, and has been monitored just because of they had that they were manufacturing accounts, if you recall. It was just there's a whole lot of controversy there. Earnings in Europe from Richmond, WH Smith, JD Witherspoon, and Burberry. UK inflation has already been released, and it is red hot. So very interesting morning note, right? I'm just thinking in terms, before we get on, let me do something just talking about banks. Just want to show you guys something. Just something for consideration. So the way a bank typically is going to make cash is through its yield curve. It's through its yield curve. So what happens here? This is how much it's going to pay for deposits. Okay, so they're going to pay. If you put money into your account and you're in an interest-bearing account, you're not going to earn much, but you're still going to get paid. And they also they earn interest off of what they lend out, right? So there's a tension between loans and borrowings. That's effectively a bank. But what happens is we've now moved into this hiking environment. We've moved into hiking, so we know that rates are moving up, and it looks like they're going to be quite aggressive. So effectively what happens is those get passed through to the commercial banks, and they can start steepening their yield curves, right? So they'll pay you more, but they'll also charge more, and the spread expands. So a hiking environment tends to be good for banks. So we've had poor bank results for the fourth quarter. I think it's just a sector that's worth monitoring, given the cycle, the part of the cycle that we're in. Peter is just writing, this is a result of inflation at 7%, interest rates very low, so negative real rates, the system crashes. Yeah, so negative rates actually, I'll show you how negative rates factor in here. Again, I don't want to spend too much time on it, but effectively, what you see, commercial banks they're the linchpin, right? They need to get monetary policy sort of working. The commercial bank is the linchpin. So prior to interest rates moving up, we had extremely low interest rates. We all know that, close to the zero bound. And when you have interest rates that are close to the zero bound, you've got a very flat yield curve for a commercial bank. It means that the amount that you are going to pay, so you're going to pay over here, and the amount that you're going to earn here is very narrow. Okay, your profits are negligible, basically. So, you know, a bank's going to think in terms of risk reward. Well, if we're not going to earn that much, is it worth our time actually making the loans? Is it worth our time making the loans? Because there's certainly going to be some bad debts there. We've got a vet. We're moving into a pandemic period. We've got no yield curve to effectively incentivize us to pass through the monetary policy. So the central bank says, okay, I hear what you're saying. Okay, I hear what you're saying. So what the central bank will do is, so let's just put in a set of axes. Okay, so we're pretty close to 0 here. We'll make this 0. That's not a 0. That's an O. Just take it as a 0. But what the central bank will say, they'll say, okay, well, we hear you. You've got no profit incentive. You're a profit maximizing institution. We're going to move the interest rates to negative. So what it actually does, it steepens the yield curve. So it's actually, in the short term, seems like a good idea. Again, I think it's part of the experiment, but you can see that the spread here widens significantly, and that prompts the banks to actually get on with the job in terms of being the linchpin. Anyways, we won't spend too much time on that. But we're in a different world now, aren't we? We're in a different world now. In fact, if we go through to German bunds over here, I'm going to have to come back to this. Control, I'll just copy that. Let's just go to German bunds. That looks odd. What's going on there? The logarithmic, that's why. All right, well, something extraordinary has happened here. Can you guys see it? You guys see what's happening to the German Bund? Something extraordinary has happened here. Can you see what's happened? Let's take this out. Can you guys see what's happened here? Let me go back in time. Watch this. Watch this. I'm going to put the zero bound in. Let's get rid of this. Let's put the zero bound in. Let's change this to a solid line. How's that? Can you see what I'm saying? You've been in a situation where the Bund has been yielding negative rates since March 2019. Okay, take a look at where we are now. So since 2019, we've been negative. Okay, this week we've just hit positive. How's that? Just as a emphasis on the change up in the economic situation. German bunds just went positive in terms of yield. That's amazing. All right, and let's just go back to this. Let's just go back to this over here. This is the Nasdaq divided by the S&P, divided by the Dow Jones. I put in the zones. So take a look where we are. We're in zone 3. We're in the bear area, right? In the bear area. In other words, so the Nasdaq's the numerator. So if the numerator is performing stronger than the denominator, which is US 30, we should get a line like that. But you guys can see we've pushed down. So it looks as if there is a rotation taking place out of the growth sector into the more mature value-based sector. So I wanted to show you guys this. So techs, I think, kind of come under pressure if yields continue to head up. I don't think that it's showing any signs of stopping just yet. And we've looked at yields in terms of the US 10-year. And you can see here the yields are in the bullish area. And we're talking about yields. So bond prices will be moving down, bond yields moving up. And we put in a target here. Now, again, don't regard the target as anything but let me just put the algorithmic as anything but interesting. We might hit 3%. We might go higher. In technicals, they say the measured move is the minimum. So maybe we're at 3%. We're in a very, very different economic situation than a year back, than 3 years back, and 4 years back. So the fact that the yields are moving up, that's going to hurt growth stocks. Okay, so the rotation into cyclicals is certainly something that needs to be watched. And with that all said and done, here's the US markets before we go into the DAX, and they just really showing signs of capitulation at the moment. So we're moving, this is the US 30, it's moving from the bull area into neutral. We're not quite in the bear area yet. Its momentum's holding up. You go through to the S&P 500, it's also showing weakness, moving from bull to neutral. Its momentum's just crossed down below 80, so we want to just keep an eye on that. But here you can see the relative weakness in the NASDAQ. See, and that's directly because of the sensitivity to interest rates. So you can see that it's not in the neutral area, it's actually gone all the way through to the bear area. So it's threatening to go into the bear area. Whether it stays there or not, we don't know. We have to monitor it. But the stochastic is showing signs of positive momentum waning, negative momentum waxing, so to speak. And the idea is this is why there is a potential reallocation from the growth to the value side. Let's bring up the main layout here. Just yeah, let's say that. Just 2 more charts to look at before we get to the DAX. It's almost coming through. I'm sorry, I don't know why it took so long there. Let's just go through to, we'll come back to this in a moment. We'll go through to US dollar. Okay, US dollar is now moving out of zone 3. Okay, it's out of the bear area, it's pushing into neutral. You go through to the weekly. Okay, we just want to see if this 2-3 correction is a potential buy the dip. Okay, well, and we've seen the yields just jumping. So that's the first thing we want to just take a look at. Let's take a look at gold. All right, so gold's actually very resilient in this type of environment. I want to see if it dips from zone 2 into zone 3. So let me take this out. I don't know what this is. I will just go down to the daily here. Okay, so gold's just treading water at the moment, but I think that the interest rates there could hurt gold. So just something I think that needs to be added to the watch list. All right, let's go and take a look at the DAX. All right, so the DAX, following the rest of the global markets down, we're in zone 3 now. This is on the daily chart. Let's just go through to the weekly. And this is a, it's not looking particularly good, is it? This is a big changer from yesterday. If you remember yesterday's candle, it was a short inside period. Well, no, that's no longer the case. Now we've got a long emotional sell down. It's a long red candle. We can adjust this. We can adjust this like that. So we've got this, and these colors are probably confusing. So let's just change this red. So we've got this red candle now. We're combining these two. So what's happening here is effectively a uncertain 2 weeks leading into an uncertain beginning of the week. We said yesterday uncertainty equals risk. Watch out. Okay, now that risk is playing out. I don't know if the candle at the end of the week is going to look as bearish as this, or is it going to be more bearish? So what we do is we watch the daily chart. Where are we in terms of zone analysis? And you can see that we're in zone 3. Okay, we're in zone 3. These we can delete. They're no longer in play. So these we can delete. We would have something like this now. 1, 2, 2, 3, and here's the push down 1, 2. So on the daily chart, it's looking very tricky indeed. Take a look at the stochastics. Stochastics now making its way down to 20. If it hits 20 and holds there, that's bad news. That's where the real damage can be done. At the moment, you know, we're still kind of hoping, and hope's not a great strategy, that we don't develop a trend in zone 3, but it's certainly looking quite ominous. So let's just put this together, and then we'll go down to the hourly. We've got a really tough bearish candle. It's not complete. Where it completes on Friday, I think, is going to be important. Daily chart has shown now signs of capitulation. We'll go down to the hourly, and we can see that we've moved now into the 20 on the hourly. This leg here, perhaps a little overdone. I mean, I think we can all see the signal was given back there late to the party. This signal over here, you know, we kind of see it in hindsight. It looks good. It was a very uncertain longer term time frame. So perhaps we want to see a bounce up to the central pivot and see if the shorts target the central pivot. So that's what I'll be looking for today, but perhaps a little extended to the downside. We're not oversold, but I think that S1 may be supported. Just some sort of risk-adjusted entries, probably something to keep in mind. Yeah, and Pete's just saying the UK inflation is now 5.4%. It's crazy. So I think the fact that the Bund has pushed positive says it all, right? Although the Bund, you know, is for Europe, but even Europe, which has been struggling to get some sort of traction in terms of inflation, their benchmark yield has just pushed positive. That's amazing. Let's just take a look and see what's happening with the British gilt. It is strong as can be. It's as strong as can be. So it's in zone 1. And one last thing to take a look at. Let's just take a look at the yield curve here. Got that right? That doesn't look right. Something's wrong here. Let me just do that again. US 10-year minus US year. Yeah, that's better. All right. So we've got a huge flattening of this this yield curve. We want to watch this now. We want to watch this because when we read the CNBC note, it's already said that the 2-year yield is starting to push up. Well, if the 2-year yield is starting to push up, that's going to flatten this yield curve even further, unless the 10-year can keep pace, which it hasn't been. And what I think is going to happen there is as soon as the normalization of the balance sheet starts taking place, we're going to see something like this. I reckon we're going to see something like this. And I think then you watch the dollar, okay, because the dollar would probably respond to that, one would think. So in that regard, March is probably the first rate hike. Normalization of the balance sheet. In my estimate, it hasn't been confirmed, but in my estimate, maybe we're looking June. So just keep an eye out for that. All right. Any other questions? Please go ahead and type those through. Any other questions? Go ahead and type those through. But it's a seriously interesting start to 2022. Quibus just saying he's looking at an interesting tweet. Over the last 20 years, Berkshire Hathaway up 548% and gold up 548%. Which part? Pete, I'm just saying that Quibus is saying he's reading a tweet. So I haven't seen the tweet. He sent it. Over the last 20 years, Berkshire Hathaway up 548% and gold up 548%. That is interesting. I think I seem to recall his annual compounded rate about 20%, but again, I picked that up a couple of years back. Did I answer the question there, Peter? Is that what you were asking? So, I think when the unwinding of the balance sheet starts taking place, we're going to see this move up in this northeast, and I think that it's going to be interesting how the dollar responds to that. All right, I think we'll leave it there, guys. I'm going to be working on this report, so we won't do the US Open today. I'm begging your pardon, but I need to get it finished by today, and I look forward to speaking with you tomorrow morning. Thanks very much, guys.